Have you ever wondered how a bank account overseas could unravel into nearly 2 decades of tax trouble? That's the story of Kamal Azmaish Fird, whose case was decided by the Tax Court of Canada in 2025. I'm Amandeep Singh, a CPA here in Canada, and today I'll take you through this fascinating journey that spans across continents, tax forms, and years of reassessments. Let's rewind to the late 1990s. Mr. Azmaish Fird opened a Swiss bank account. For many Canadians, the idea of a Swiss account brings up images of secrecy, but what really matters here is that any income from such accounts must be reported in Canada. And there's another key obligation, the T1135 form. This form requires Canadian residents to disclose foreign property worth more than $100,000. From 1998 onward, that disclosure did not happen. For 15 straight years, the CRA said there were unreported amounts and missing forms. The agency reassessed those years, adding income from the account and imposing gross negligence penalties. These penalties are not light. They are designed for cases where the CRA believes the taxpayer showed serious carelessness. The courtroom scene was intense. On one side, CRA lawyers argued that year after year the omissions could not be accidental. On the other side, the taxpayer tried to defend against the reassessment and penalties. The judge sifted through evidence, going all the way back to the 1990s, examining the records, the filings, and the obligation that had been ignored. The conclusion: for the years 1998 through 2013, the court agreed with the CRA. The income was indeed left out, the disclosures were not filed, the misrepresentations were caused by neglect or carelessness. The reassessments for those years stayed in place, along with the penalties. But then came an unexpected twist. The CRA had also gone after 2014 and 2015. The judge looked at the clock, literally the statute of limitations. For most taxpayers, the CRA has only 3 years after a return is filed to reassess it, unless there's misrepresentation. In this case, the court found that the reassessments for 2014 and 2015 were too late. These years were statute barred. And not only that, the judge also vacated the gross negligence penalties for those 2 years. So, the final outcome was split. The CRA prevailed for 1998 through 2013, but the taxpayer won partially for 2014 and 2015. This case matters because it shows how long the shadow of unreported income can stretch. Once a pattern of missing foreign disclosures exists, CRA can dig back many years and the financial consequences can be massive. Yet, at the same time, rules about limitation periods protect taxpayers when the reassessments come too late. At Cloudiver CPAs, we help taxpayers stay compliant in the first place, so situations like this never reach the courtroom. The lesson here is clear. When it comes to taxes, especially with foreign accounts, accuracy and transparency say far more than years of legal battles ever could. Thanks for watching. I'm Amandeep Singh, and I'll see you in my next video. Until then, bye.